Okay, good morning, everybody. If I have your attention, please. Lovely, thank you very much. Well, welcome to our Autumn 2021 Budget Breakfast. It's great to see you all back here. It's been a long time coming. I won't say any more than that because that'll just be tempting fate. Well, earlier in the week we had Rishi's more budget, or was it more of an autumn statement? More jobs, more wages, more growth, less borrowings, more inflation helps. Rishi did go to the trouble of defining inflation for us. It's caused by less supply and more demand, apparently. So clearly an economic genius there. But today we're here to look beyond the political sentiment of the budget and to look into the detail. In some areas there was clearly quite a lot of detail. In other areas there was precious little. So I think our presenters have had their work cut out for them this morning. So taking us through it, on the corporate tax side we have Katie Varney, and on the personal tax side we have Yvonne Graham. So without further ado, I shall hand over to Katie.
All right, thanks, Malcolm. Morning, everybody. So I'm going to run through the corporate and business tax elements of the budget this morning. I think given that the March budget was fairly jam-packed with corporate and business tax announcements, nobody was really expecting anything significant to come out of Wednesday's speech, and they weren't wrong. That said, at least there's a bit more to probably talk about from the corporate and business tax side than there is from the personal tax side. But I'm going to run through this morning the things that were newly announced on Wednesday, and then a couple of measures that have actually been announced in the intervening periods between the two budgets. So we'll start by looking at what's new. So in terms of R&D, I think the Chancellor talked a lot about R&D in his speech, about the importance of investment in R&D and in innovation, how it's going to drive economic growth and create the jobs of the future. So at that point, I got quite excited that we were going to see some quite significant reforms to R&D tax reliefs, particularly the SME scheme, which historically has been restricted by the constraints of EU rules, EU state aid. So now that we're out of the European Union, I thought perhaps we'll see something quite significant there. But like with many things in life, it was a bit of an anticlimax. So there were really only two changes announced. Now, one of them was very welcome and something that actually the industry has been pushing for some time. And the other, although dressed up as a positive in the speech, is actually going to see relief restricted in many cases. So the good news is that the definition of qualifying expenditure for R&D tax reliefs is going to be expanded to include data and cloud computing costs. So it seems that the government has finally kind of woken up to the irony that a relief that's designed to encourage innovation and cutting-edge development has actually been quite outdated for some time. So historically, costs to qualify for R&D tax reliefs have needed to fall into four main categories. So it's staff costs, it's externally provided workers, software and consumables, and then subcontractor costs. There are also reliefs for payments to subjects of clinical trials and contributions to independent research, but we don't see those very often in practice. Now, the problem with this is that the definition of software is very narrow and has been or remained unchanged since it was introduced in 2004. And the guidance and the legislation really helpfully just says that software means computer software. And that has been to the exclusion of any modern developments in methods of research and development. So that's welcome. From April 23, we're going to see the definition expanded to include data and cloud computing costs. Also expected to come in from April 23, we're going to see a restriction on reliefs for R&D costs incurred outside the UK. So as I've kind of already said, subcontractor costs are one of the the qualifying categories of expenditure for R&D tax relief, and it's quite common that a project, an R&D project, or at least an element of a project, would be outsourced or subcontracted to another party. And as the rules currently stand, that subcontracted activity doesn't need to take place in the UK to qualify for the relief. The subcontractor doesn't even need to be based in the UK. So that's meant that UK companies have been able to benefit from relief on subcontract costs. I don't know, perhaps they needed skills that are only found in a handful of global locations, or if they were part of a group, they've been able to utilise the resource and expertise in other group companies outside the UK. So the government has decided that, that doesn't really mean we're efficiently recognising the benefit from the UK taxpayer of these reliefs. So they're going to refocus that relief to make sure that actually we're more in line with what other countries are doing, notably Australia and the US, whose R&D tax regimes do not allow relief on R&D expenditure incurred overseas. So although it was badged as, we're going to focus on benefit to the UK, I think actually that's going to see a restriction in many cases. We haven't got the detail yet as to how that's actually going to be implemented. We're expecting that to come out later in the autumn, along with the government's proposals as to how they're going to tackle abuse and improve compliance with the R&D regime. Now, this again is something that the industry has been lobbying for quite some time. The R&D market is currently unregulated, which means basically anybody could be an R&D advisor. And we do see R&D advisors of varying degrees of quality, I would say. And at the moment, there's no recourse to the advisors. So without trying to tar everybody with the same brush, you will find some R&D firms that push the boundaries and sometimes, quite frankly, cross the line in terms of what people should be claiming. HMRC will open an inquiry into that taxpayer's claim, and then the advisor washes their hands, and it's the taxpayer who's relied on that advice that gets penalised. And actually that advisor will just, with their polished sales pitch, move on to the next client, and it doesn't affect them. So I'd like to see some kind of regulation brought into the market. Whether that's what we'll get, I don't know, but that's what I'd like to see happen. So if we move on and stick on the theme of corporate tax reliefs, now this is arguably a lot more niche and narrow in its application than R&D tax reliefs are, but I think it is worth a mention because these are some quite valuable tax reliefs that are collectively known as cultural tax reliefs that provide welcome tax breaks to businesses, companies operating in the theatre, orchestra, museum and gallery sectors, which arguably have been some of the hardest hit by the pandemic. So the first announcement is that the tax relief for museums and galleries that was due to end this coming April is now going to be extended. That's going to run for another 24 months to 31st of March 2024. And then all of these tax reliefs, they're going to be quite significant increases, albeit temporary increases, to the headline rates of relief. So for theatre tax relief and museums and galleries tax relief, the reliefs are going to change from 20% for non-touring productions and 25% for touring productions, up to 45% and 50% respectively until April 23. They'll then reduce to 30 and 35% respectively before coming back to 20 and 25% from April 24. And then in terms of the orchestra tax relief, that's going to double initially from 25% to 50%, and these are with effect from budget day. So from Wednesday, those reliefs are going to, or orchestra tax relief is going to double. It will then reduce to 35% from 1st of April 23 before returning to the normal 25% from 1st of April 24. I think that's probably all that needs to be said about that because they are quite a niche relief, but it's quite important and worth mentioning. We then come on to residential property developer tax. Now, this was something that was originally announced as being a new introduction to the tax regime in February, but it got another mention in Wednesday's speech. This is something that's broadly, it's designed to target large residential property developers to ensure they pay their fair share of a contribution towards remediation of buildings. This all stems from unsafe cladding and the Grenfell disaster. So it's going to operate as a 4% additional tax on relevant residential property development profits, and it's going to apply from April 22. Now, it's only going to apply to profits that are in excess of an annual allowance of 25 million. And again, the government's saying that this is targeted at the largest developers. Now, the issue here is that that 25 million is not on a company-only basis. If you're a property development company that's part of a group, that annual allowance of 25 million has to be shared between all of the group companies. Now, it can be allocated as you choose, as you see fit, but what it could mean is that if you've got a reasonably small property development company that's part of a much larger group of property developers, then actually that allowance could be allocated elsewhere and you could find yourself suffering that 4% surcharge. Now, we've only got draft legislation at the moment. It's yet to be finalised, but it does, on reading through the detail, look like we're going to have an exemption for housing associations, basically for non-profit residential developers. So at least that will take a chunk out of the regime. Again, I think it's probably fairly narrow in its application, certainly in this room, but something to be aware of. So from housing to shipping, and again, apologies, because this is, again, a very niche area, but I know Ensors has got a number of clients that are shipping companies, so I think, again, it's important just to cover this very briefly. Rishi talked a lot about reform to the UK tonnage tax system. Now, for those of you that don't know much about tonnage tax, which is probably quite a number of people in the room, very simply, it's a form of corporation tax that shipping companies can pay at a standard rate based on the tonnage of their fleet, rather than paying corporation tax on the actual profits realised from shipping activities. And companies that elect into the regime have to do so at the moment for a minimum of at least 10 years. They have to comply with various obligations, including flagging rules. Now, flagging, without going into a lot of detail, is basically related to where vessels are registered, and it encourages ships and vessels to be registered in an EU member state or an EEA member state. So the reform is going to remove those flagging rules and encourage ships in the UK tonnage tax system to fly the UK flag, and it's going to reduce that lock-in period from 10 years to 8 years, which is more in line with shipping cycles. So I think that will be quite welcome by people in the industry. There's going to be some simplification to the definition of relevant shipping profits, which again, I won't go into, but will be welcome. And it's also going to increase HMRC's powers to actually admit elections into the regime outside the normal window of opportunity, which is quite a narrow window, actually. It's usually you've got 12 months from the date your company qualifies to elect in, and if you miss it, that's it. So it's a bit more flexibility here under the new proposals. I don't think I need to say a lot more about it because, as I say, it's quite niche and it is quite targeted in its application. But again, we've got clients in that industry, so it's worth a mention. So if we move on to something that isn't technically tax, but hopefully more applicable to most people, if not everybody in the room, the government has been consulting earlier in the year on reform to business rates, and though it's technically not published as part of the budget documents, it's published alongside the budget documents, and it was mentioned in the speech, we have got quite a lot of reform to business rates. And it's mostly good news, I think. The multiplier that's used to calculate business rates is going to be frozen in 22 and 23, so no inflationary increases in business rates, which has to be a good thing. We're going to see the introduction of a relief for eligible retail, hospitality and leisure properties. Again, that's one of the sectors that's been hardest hit by the pandemic, so that is quite welcome relief. And it's going to be a 50% relief, so 50% saving on business rates. That's up to a cap of £110,000, and that's not per property, that's per business. We're also going to see from April 23 the introduction of an improvement relief. And what this is going to do is for a 12-month period, it's going to shelter businesses that have undergone improvements to their property, that have increased the rateable value of that property. So it's going to shelter them for any increases in business rates that would come from that uplift in value for 12 months. So that's a good thing. We're going to see the introduction of various exemptions and reliefs for green technology for a limited, albeit quite long period. That's going to come in from April 23 until 31st of March 2035. And it's going to be specifically looking at things like solar panels, wind turbines, that sort of thing. And then one of the other big announcements in terms of business rates was around revaluations. So currently, the revaluation cycle for business rates is 5 years. Properties are required to have a revaluation every 5 years. And that period of time has come under quite a lot of criticism, because I think a lot of it's based on high street valuations, and that 5-year period doesn't really take into account the declining interest in the high street over that period. So under the new proposals, that cycle is, or the frequency of the revaluations are going to be increased to every 3 years, which I think should give a fairer result to most businesses. Not technically mentioned in the speech, but published in the budget documents that get published alongside that. We've now got the new set of ATED rates that are applicable for the 2022-23 year. Now, for those of you that don't know what ATED is, it stands for the Annual Tax on Envelope Dwellings, and it's targeted at companies that hold expensive residential property. Now, there are lots of reliefs and exemptions from this tax regime. It could be that you've got the property held for commercial rental purposes, that it's a farmhouse, perhaps used in a working farm. Often we see a lot of property developers who hold completed houses as trading stock that could be caught by this but can then claim an exemption. So there are lots of exemptions that apply and reliefs that apply. But if none of those do apply and you're within this regime, this is a tax charge that has to be paid every year, and we can see that it's increasing in line with CPI. I think another point to note is that the amount of the charge is based on the taxable value of the property, and at the moment, that valuation date is the 1st of April 2017. Now, that valuation date changes every 5 years. So it will remain as April 2017 for returns that are due to the period covering up to the 31st of March 2023. But then when we get to the period ended 31st of March 2024, we're going to have a new valuation date of the 1st of April 22, which I think is going to see potentially, given the increase in property values over that time, quite a few more companies potentially brought into this regime. So not particularly exciting, but something to just be aware of. Other points of note before I come on to perhaps the biggest thing from a corporate and business tax perspective. I think this is really the only mention of employment taxes. And again, not covered in the speech itself, but in the backing documentation. We've now got confirmation of the amounts for van and fuel benefit increases from 2023, increases based on the September CPI index. So van benefit's going to increase to 3,600, van fuel benefit to 688, and then the multiplier for the car fuel benefit is now a whopping 25,300. So, I mean, if there are people that are still having, or have got company cars and having fuel paid for by the company, it's getting incredibly expensive. So that may be something that you want to look at sooner rather than later. There wasn't much in the budget in terms of capital allowances, and that's probably not that surprising, given that there were significant announcements in the March budget with the introduction of the super deduction and 50% first-year allowance for special rate assets for companies. But we did have one point of note, and that relates to the annual investment allowance, and it's relevant to both companies and unincorporated businesses alike. So the AIA, since its introduction, has been increased and decreased multiple times. It was then fixed at a permanent rate of 200,000. I should have put permanent perhaps in inverted commas, because it was then temporarily increased to £1 million again. But that £1 million extension was due to end 31st of December this year. That has now been extended for 15 months, so that £1 million is now going to stay in place until 31st of March 2023. Now, as ever, when we get a change in the amount of the AIA, and you've got an accounting period that straddles that date of change, there are complex transitional rules, and timing of expenditure is going to be key. But I think a lot of businesses will already have accelerated expenditure to get it in before Christmas, to make sure that they maximise their allowance. That, in hindsight, now wasn't necessary. But we will, I'm sure, revisit this in another 12 months' time to make sure that people are planning for the change in March 23. Right, so we then come on to what is probably the biggest topic that I've got to talk about and wasn't actually mentioned in the budget speech at all. This is something that was announced between budgets and relates to the way in which unincorporated profits, so sole traders and partnerships, how their profits are allocated to tax years. So under the current system, and I'll just click through all of these. Under the current system, we have what's known as a current year basis. So broadly, in a tax year, you will be assessed a tax on the profits of your accounting period that ends in that tax year. So if we took a 30th of June year end, 30th of June 2021 falls between 6th of April 21 and 5th of April 22. So the results for the 30th of June 21 will be taxed in the 2021-22 tax year. There are special opening year and closing year rules when you first start trading and when you cease trading or change your accounting date. And that can sometimes mean that in the opening years, you've got profits that fall into multiple tax years and therefore get taxed twice. But those overlap profits are then relieved when you cease trading or change your accounting date. Under the new proposals, we're effectively going to be switching to an actual year basis. So whatever money was earned in that tax year to 5th of April or 31st of March, that's what's going to be taxable. So effectively, unincorporated businesses have got two choices. You could change your year end to align with the tax year, either 5th of April or 31st of March, so that your accounts are prepared to that date, and that profit, whatever those accounts show, that's what's going to be taxed in the tax year. Or you can keep your tax year, keep it as it is, but you're going to have to then apportion your profits between tax years when it comes to preparing your tax return. So again, if we stick with a 30th of June example, you'll have the first 9 months of your year that fall into one tax year, and then you're going to have the final 3 months of the year are going to fall into the next tax year, and they'll be taxed alongside 9 months of the next set of accounts. And both of those options come with their issues. Frankly, from a very selfish point of view, if everybody changes their year end to the 31st of March or 5th of April, it's going to be a nightmare for accountants. Everyone's going to have the same year end, everyone's going to bring their books and records in at the same time, everybody's going to want their work done at the same time. And it's going to be awful. You know, it really is. I can't emphasize that enough. Don't all change your year ends. But the problem is if you keep your year end and then adjust and apportion your results, we're often going to find the scenario where that second set of accounts that's going to form the final part of that tax year may not have been finalised yet. The year end may not have even come around yet. So what you're going to have to do is estimate your results for that second period, file your return based on estimates, and then once those accounts have been finalised, amend your tax return with the final numbers. And that's going to come at a cost, because that's going to, it's another filing, it's more work. So this has been billed as a measure that's going to simplify things and help people split their profits and allocate their profits in conjunction with the move to making tax digital for income tax. But really what this is going to do is accelerate revenue and related tax liabilities for a lot of businesses. Because what we've got in the year of transition, so the year that we move, 2023 to 2024, is when this is proposed to come in. It was originally 22-23 and has already been pushed back a year because of kind of uproar from the profession. But in that transitional year, the plan is that you're going to tax everything from the end of the last period that was assessed in the previous tax year right up until 5th of April or 31st of March 2024. So if I show that by way of an example, sticking again with the 30th of June year end, that's going to move to a 5th of April or 31st of March year end. So under the opening year rules when it first started, actually 9 months of those profits got taxed twice. So we've got overlap relief for 9 months worth of profits. In the transition year to 2023-24, we're going to be taxing the period from the 1st of July 2022, because if you think about it, in 2022-23, we taxed the profits up to the 30th of June 2022 under the normal rules. That was the accounting year that ended in that tax year. So we're going from the start of the new period, 1st of July 22, right up to 31st of March 2024. That's 21 months worth of profits that are being taxed in a single tax year. Yes, you'll get your 9 months worth of overlap relief, but if you started your business some time ago, that's probably going to be considerably lower in real terms. 1997, I've got there in brackets, that was the year that we switched to self-assessment and to the current year basis that we currently operate. So potentially 9 months worth of overlap profits in 1997 are worth a lot less than 9 months worth of profits would be now. And actually it's not an additional 9 months worth of profits, it's an additional, well it is, yeah, an additional 9 months worth of profits now. So it's going to accelerate tax for a lot of people. The government are aware of this. They know that that's the case. They may not be badging it as such and promoting it as such, but they are legislating that there will be an automatic spreading of these additional profits over 5 years. They're also going to legislate to say that you can elect to opt out of the spreading and tax everything up front as if those profits did arise in the year of transition. Unless you know that there's an increase in tax rates coming, I'm not necessarily sure why you'd want to do that, but the option is going to be there. But yes, I think all that glitters is not gold with this, and although it is being badged as simplification, I think it's probably far from it and is going to cause real tax implications and cash flow implications for many businesses. So I think after the doom and gloom of basis periods, at least the one good thing that came out of the budget is under the alcohol duty reforms, Prosecco is going to be cheaper, 87p cheaper on a standard £7 bottle of champagne, but it doesn't come in until April 23, so I'm afraid you're going to have to wait until the spring budget of March 23 before you're provided with Bucks Fizz on the table. And on that note, I shall hand over to Yvonne, who'll take you through the personal tax implications.
Well, good morning, everybody. Love to see so many people in one place. It's a real pleasure. I'm going to talk about income tax and other personal taxes. Now, I'm not sure that Dishy Rishi even mentioned income tax in his speech, so I could very well just go and sit down now and you could all go back to your offices. But as we're here for another 20 minutes, I'm afraid you're going to have to put up with me maundering on about stuff. First of all, what didn't Rishi say? He didn't mention various things. He didn't mention that he's frozen tax allowances and thresholds for quite some time to come. He didn't mention the new health and social care levy, which I will talk about in a bit. He didn't mention, as we had widely feared he would, an increase in the rates of capital gains tax. So those have not changed, and they're not scheduled to change as far as we're aware. He didn't mention pension tax relief, which costs the government a lot of money every year. Again, that's something that comes up every single time, that pension tax relief is very expensive, it's going to be taken away or shut down from for high rate taxpayers. He didn't mention that at all. He also didn't mention the fact that the gross tax burden is going up to its highest level since the 1950s, which was the Clement Attlee government, at 36.2%. Now, I don't actually remember the 1950s. I was around, but I don't remember the 1950s. I do remember the adults in my life at the time watching the budget very carefully every year, and I was annoyed. Whoops. I was annoyed because it meant there was no children's television that afternoon. And they were very concerned about tax, and it was a real talking point. But I think these days, people don't take it quite so seriously. So I've called this the dog that didn't bark budget, which is why I've called this slide Silver Blaze. Now, this is my fault. I thought that the dog that didn't bark came from a Sherlock Holmes story, which I was quite right about, but I thought it was the Hound of the Baskervilles, but it's not. Apparently, it's a short story called Silver Blaze, where a whole crux of the whole case was the fact that the dog didn't bark in the night. So this is the dog that didn't bark budget, Silver Blaze. Rishi Sunak going down in a silver blaze of glory. Now, about the income tax and the things that Katie's just been talking about. These slides show gross tax receipts for the government, exclusive of borrowing, for the 2 tax years, 2021-22, and next year from April 22-23. Now, this is just the total split into various taxes. And as you can see, the light blue quarter, that is income tax. The orange quarter, not nearly a quarter, is VAT, and the grey one is national insurance. And the yellow one is everything else. So everything that Katie's been talking about now is encompassed in that little yellow slice, which is, as you can see, being shrunk next year because he's giving away all his money. The one thing, the two segments that are increasing next year are the income tax one and the national insurance one. Now, these are very, very important taxes, as you can see. It's the main plank of the government's income. So income tax, VAT, and national insurance. And he didn't mention income tax at all. I keep doing this. He didn't mention income tax at all or national insurance in his budget, but these are the ones that are going to drive the economy for the next few years. So Malcolm said this is the more budget. Well, this is, as far as we're concerned, us taxpayers, it's going to be the less budget. Oh, sorry. Just to put those figures in a little bit more context, these are estimated tax receipts in billions. Income tax, as the column up there, is going to go up a little bit. VAT is going to go up a little bit more. National insurance is going to go up a little bit, and everything else is going to go up a bit. But as I've said, these income tax and national insurance, which is the ones I care about most, are going to go up, despite not having been mentioned in the budget, and we don't quite understand how this is all going to happen if there's no changes. Well, the reason this is all going to go up, despite there being no changes, is our old friend fiscal drag. Now, you may wish that you'd gone to our Bury office tax budget breakfast, because my colleague Danny is providing the slides and doing the talk there, and he is using as his theme the RuPaul drag race. And apparently he has pictures of drag artists, and I've got no pictures at all, I'm afraid. Sorry, you should have gone to Bury. But fiscal drag obviously means that the government, or the Treasury, or whoever it is, they don't squeeze the allowances, they don't change the allowances, they just let them stay the same. So inflation goes up, your pay goes up, but the proportion of your pay on which you pay tax also goes up because the allowances stay the same. So as an example, I've got some examples here, and I put in brackets what the relief was in 2012-13, so 10 years ago. 10 years ago, the personal allowance was £8,105, and that has increased quite considerably to £12,570. That was a Conservative Party manifesto pledge, that they would increase it to £12,000, which they did a couple of years ago, and they trumpeted at the time that they put it up early. Age reliefs for those born before 1935 are now broadly gone, and the date at which these age reliefs apply is still those born before 1935. So the people who are able to benefit from these reliefs, there's fewer and fewer of them around. The basic rate is going to go up to £37,700, and in 2012-13 it was £34,370, a very small increase, I think you'll agree, over a 10-year period. More and more people are being dragged into the 40% tax bracket. We're not necessarily earning more relative to everybody else, but we're just, because the basic rate band has not kept pace, then more people are paying 40% tax. The higher rate tax applies, 40% applies on income up to £150,000. That has not changed at all since it was introduced. It was £150,000 10 years ago. It's still £150,000. Although, having said that, initially, the tax rate on income over £150,000 was 50%, but that only lasted for 1 year. It was discovered that it was such a big disincentive for people to go out and earn money and be more productive that they reduced it to 45%, where it's stayed ever since. Going on, there's loads and loads of these that you can talk about. The restriction on the personal allowance. Once your taxable income reaches £100,000, you start to lose your personal allowance and you have an effective tax rate of 60% on that band of income. That was set at £100,000. It's still £100,000, no change. The child benefit clawback, which came in January 2013, so it's just less than 10 years ago, that applies when income goes above £50,000. It's still £50,000. So more and more people are being dragged into this 60% income tax rate, or this effective losing their child benefit. The only one that I could find that was a really positive story, no, this is a negative story, isn't it? Sorry. Entrepreneurs' relief was £10 million. Now it's just a measly £1 million. So it's been called something different now. It's called business asset disposal relief, but it's still relief that applies when you sell your business. It used to be the case that you could realise a gain of up to £10 million and pay only 10% CGT. And that is now just £1 million. The inheritance tax nil rate band, £325,000. Oh, goodness me, it was £325,000 10 years ago. That has not changed. And again, government receipts from inheritance tax have increased considerably. Although going back a couple of slides, if I can. Inheritance tax is included in that yellow section, which is going down. That yellow section includes, I should have said this before, corporation tax, business rates, excise duties, all the other taxes, excise, climate levy, all those different pieces, inheritance tax, capital gains tax, they're all included in that yellow one. So although, and beer duty, and Katie's cheaper, champagne, they're all included in that yellow one. That is so little, has so little importance in the terms of the whole government borrowing income and expenditure that he can afford to make these little giveaways, which give him, of course, a lovely headline in the next day's paper, 3p off a pint of beer. Wow, fantastic. Your income tax is going up by much, much, much more than that. So going back, where was I? Yes, and the final one on this slide, which even I was surprised about this. I hadn't thought about this at all until I started looking back on my old tax facts. If you use your own car for business, you can claim money back from your employer to reimburse the cost of that. It's 45p a mile for the first 10,000 miles, goes down to 25p a mile for the first 10,000 miles. That has not changed in 10 years. Now, looking at how much it cost to fill up my car this morning with petrol, that can't still be right. I mean, it was very generous, I have to say, when they first introduced it. But now it's looking less and less generous. And for bigger cars, it really doesn't even cover the cost of running your car. And that's a statutory rate, by the way. That's set down by law. The employer can pay less if they want to, but they can't pay more tax-free. So coming to this was introduced a while ago. It didn't merit a mention in the budget, but this is the one reason why the national insurance slab of my pie chart is going up so much. The national insurance and health and social care levy. I should mention the national insurance threshold is going up from a measly £9,500 to a measly £9,800. A lot of people don't realise that you start to pay national insurance on earnings long before you start to pay income tax. The threshold is much lower. The upper earnings limit is staying the same, and a lot of these limits are going to stay the same for quite some time to come. The employment allowance, £4,000, that's the amount a smaller employer can claim if they pay employers national insurance, that's £4,000. So what's he going to do? This was supposed to be ring-fenced to cover extra costs for the NHS and social care and all that sort of thing. They're going to be a 1.25% increase to both the employers and the employees' rates of national insurance. So 2.5% rate overall. And as it says, the 12% is going up to 13.8, etc., etc. And for those people who are lucky enough to earn enough so that they hit the upper earnings limit of 50,284, they also will pay an extra 1.25% on top of the 2% they already pay. So if my maths is right, that means, although 1.25% doesn't sound very much, does it? You think, well, I'm only going to pay 1.25% more. That's not very much at all. It actually comes to just under 10% of the total national insurance that you pay, because it's 1.25% of amount. Now, I've put ring-fenced in it with a question mark, because although they did promise it would be ring-fenced, hypothecated, we don't have any details of exactly how that's going to work. How long have I got? 5 minutes. As part of what I was thinking about, of this, fiscal drag, the restriction on rates, I thought perhaps it would be worthwhile just sort of reiterating how the tax on investment income works. The reason this came up is because the 1.25% on national insurance is going to also be added to the tax on dividends. So currently you pay 7.5%. A basic rate taxpayer pays 7.5% tax on dividends. That also is going to go up by 1.25% from April. But because tax is very simple, it's essentially very, very simple, so this is bread and butter stuff for somebody, not me. I had to sit down and work it out very carefully. So if you have investment income, you have a starting rate band of £5,000 at 0%, and most people don't even realise that this exists, but this only exists for a very small select group of people who don't have much in the way of earnings but have some investment income. There's a personal savings allowance of £1,000, so if you receive interest of up to £1,000 and you are a basic rate taxpayer, that first £1,000 of investment income, interest income, is taxed at 0%. The £1,000 goes down to £500 for people who are into the 40% tax bracket, and then it disappears entirely for those who are in the 45% bracket. So again, more people are being dragged into the 40% band, therefore they're going to lose half of their personal savings allowance, and if we were lucky enough to get any interest on our savings anyway, we'd actually end up paying more tax on that as well. The dividend allowance, so the first £2,000 of dividends that you receive, you don't pay any tax on at all, and there's no restriction on that. You can pay 45% tax or whatever. Everybody gets the £2,000 relief. Again, why? Why is one relief withdrawn for people who pay higher rate tax and not for others? It's supposed to make life easier, but it really doesn't make life easier for anybody. Currently, basic rate taxpayers pay 7.5% tax on dividends above £2,000, and 32.5% for 40% taxpayers, and 38.1% for additional rate taxpayers, those rates are all going to go up by 1.25% from April 2023. 2023? Is that right? Yes. I think that's right. So again, this is just a sort of mishmash of different rates and different allowances, so it's really hard to keep up with what you're paying tax on and what you haven't got to pay tax on, what might be covered by an allowance, what is covered by an allowance. And the message I think to take home is the fact that more and more of us are going to be 40% taxpayers. We're going to have to start thinking about these rates of tax on our investment income. So there were some other announcements. Nobody mentioned income tax. I don't think VAT was mentioned at all. Not one word about VAT, which is an incredibly important tax. As you can see from my slide, broadly speaking, a quarter of government income is VAT. Not one word about VAT. There were some announcements, though, that he didn't mention in the speech, but came through in the small print afterwards. At the moment, if you sell a residential property, which is not your main home, because that's exempt from capital gains tax most of the time, and you make a capital gain, you have a 30-day window in which to make an online report to HMRC of the gain you've made, and you have to pay the CGT within 30 days. It doesn't get paid at the same time as the rest of your self-assessment tax anymore. It gets paid within 30 days. From budget day, that 30-day window, which we have found to be very, very tricky indeed, to work out how much CGT, and also because HMRC don't make it tremendously easy for anybody to actually make the report online, that 30 days has been extended to 60 days, which I think is just a practical measure because so many people were having such a lot of trouble doing it within the 30-day window. As Katie mentioned, Making Tax Digital, which is the brand spanking new quarterly reporting online, which will make life so much easier for everybody. It was due to come into effect on April 2023, although it's already been put back a couple of years. They've extended that until April 2024 now. The intention being that all businesses and anybody with rental income, gross rental income, before expenses of more than £10,000 a year, is going to have to make a quarterly report to HMRC, and this is on the calendar quarters, of their income and expenditure. It's going to have to be done online. There's no option to not do it online. And it's going to have to be done within a month after the quarter end. And the government's idea is that this will make life so much better for everybody. They haven't actually said how this is going to make life so much better for everybody, but believe us, it really is going to be better because it's a brave new digital world. And everybody will have to make these quarterly reports at the end of each quarter of their income and expenditure from these various. And there will be separate reports. If you've got rental income and you've got a business, you'll have to make a separate report for the two. Easy peasy, no problem at all. That's been moved back to 2024 for obvious reasons, and I wouldn't put it past it to be moved back again, frankly, because HMRC's record with digitalization is shaky, to say the least. As Katie's already said, the basis period reform, which goes before that quarterly digital reporting, Making Tax Digital, has now been put back to 2023-24, which will be the transitional year. Hand in hand with that, there will be an increase in penalties for not complying. Of course, there's always penalties for not complying. For VAT and income tax under self-assessment, they're going to be much more, because they've got computers that will automatically spew out these penalty notices, they're quite keen on those. They can send them out without actually having to interfere by human hand. So they're going to increase the penalties, and there's quite a complicated regime of red cards and yellow cards and what have you coming in. This next one, it affects me personally. There's the suspension of the state pension triple lock. It used to be applied to, the annual increase in the state pension used to depend upon three things. It was minimum of 2.5%, or the growth in earnings, or inflation, and all of a sudden, earnings growth has just gone off the roof. So they've said, oh my goodness me, we're going to have to pay all these pensioners way too much. So they've taken that out of the equation, because then then they'll have to pay us less. And there's a very, very technical thing that basic rate tax relief for the people who actually pay pensions through their workplace pensions. If they weren't earning enough to pay income tax, they weren't effectively, under some circumstances, not getting the basic rate tax relief. That's going to be adjusted so that people can get the tax relief. And it's 9:30 and I've finished. Thank you very much.
Lovely, thanks for that, Yvonne, and thank you, Katie. Well done for picking the bones out of that. There was some really some interesting stuff in the detail there. So can we just thank both speakers again in the usual fashion? I mean, I think it's fair to say this budget probably be remembered as much for what wasn't in there as to what was in there. And as Yvonne has pointed out, the consequences that's going to have on the tax burden for quite a lot of us. And also how that fits in with Tory party philosophy, but let's not get into politics. So it just remains for me to say thank you very much. It's great to see you all here at a proper event. I'd say it's been a long time coming. Do have a safe trip back to your office or home, wherever you're going, and thank you once again.